welcome everyone to this morning's webinar for business owners. Today's webinar is being recorded and we're going to send out any slides along with the recording to all who registered. My name is Rose Kervick and I'll be moderating today's session. This is an interactive webinar, so the benefit of you being live on here is that you get to ask your own personal questions as they relate to you and your business. And we're delighted today to welcome Anya Cullen, who's a senior financial planner at Ask Paul, and Larissa Feeney, who's the founder and CEO at Accountant Online and also fellow chartered accountant. And Larissa, I will hand over to you and let you begin. Just to encourage, before I do, just encourage you all to put your questions into the chat. We have a few questions that have come to us via social media already. But do put your questions in there, and I think this is quite a unique opportunity because you have two very qualified and experienced people here, one who's very experienced in overseeing the finances of small business, and the other Anya, who's very adept and experienced at looking after our personal finances. And as business owners, it's not always easy to get a balance. Is that right, Larissa?
That's right, Rose. Good morning, everybody, and you're very welcome. Hi, Anya. So first of all, yes, my name is Larissa. I am CEO and founder here at Accountant Online, and we're delighted that, Anya, you're joining us today from the Ask Paul team. Would you be happy to give a quick introduction to yourself and to Ask Paul before we move on to first questions? Oh, have we lost Anya, Rose?
Yeah, we've lost Anya. Anya,
are
you back?
Are you back, Anya?
Yeah, I think
great.
So.
Great. Okay. Hi, Anya. Would you mind giving an introduction to yourself and to Ask Paul before we move on to first question?
Yes, so my name is Anya Cullen. I am one of the senior financial planners with Ask Paul. I'm with Ask Paul for the last 2 years, so since 2020, but I'm in financial planning since 2008. So I have a really knowledgeable background in terms of having seen the global financial crash of 2008, the recovery, and everything up to, I suppose, the financial shock that COVID-19 brought with it. So the company that I work with is Ask Paul. We are currently a large online social media presence. We are a whole of market advisor. So what that means is we are not tied to any one life company. So any of the advice, any of the recommendations that we provide is based on who's offering the best benefits at the best premiums, knowing cheapest isn't always best. We are currently managing over 203 million in assets under management. We look after over 12,000 clients and would have a very large social media following, primarily on Instagram, growing very quickly on TikTok, and would also use a number of different videos on YouTube. We would have over 220,000 visitors to our page at this stage, and on a monthly and weekly basis we're actually interacting via email or our page with over 31,000 followers. So what I would like to do is very briefly, for maybe 5 minutes, just show a couple of slides kind of highlighting where we are with Ask Paul, but really bring it into, am I still there?
You are indeed, yes.
Yeah, sorry, my slides are just taking a while to actually try and share now. Have they come up there?
That's it now.
Oh, sorry, now. Okay, so what I have just done here is, let me pop this into presentation mode for 1 sec. So as mentioned, I'm a certified financial planner, and I would deal an awful lot with the personal side, which is almost as important as your business side, because as business owners, and particularly if you're starting out, what generally happens is a lot of your focus is put towards building your business, but at the same time we want to make sure personally that you're looked after as well. So that's just a little highlight of what I have just spoken about. And then what I wanted to do is really bring in through the concept today of what is financial well-being, because financial well-being is now, it's actually rated as one of the biggest contributors to overall well-being, suggesting that it should receive the same, if not more, attention as your physical and mental health. So at Ask Paul, we have come across, it's the Consumer Financial Protection Bureau in the USA have developed this definition of financial wellness. And we feel that it kind of hits the nail on the head in terms of what we're going to discuss today from a business and personal point of view is financial well-being is a state of well-being where you have control over your day-to-day and month-to-month finances. So what this means is, can you get to the end of the week or the end of the month on your pay and not find that you're struggling, not be dipping into maybe an overdraft or a credit card, and looking at what have we got from a personal and business point of view in terms of what's coming in, but also what are our outgoings. So having control over our day-to-day and month-to-month expenses, having the capacity to absorb a financial shock. So what this means, and it's not necessarily that it's the big illness that potentially has you out of work for a period of time, but it's if something happens, do you actually have an emergency fund? Can you absorb that financial shock and move forward again? And then once that happens, are you on track to meet your financial goals? So both personally and financially, I'm sure we'll get into kind of wealth extraction today as well. But what are your financial goals? Is it to build a business? Is it to retire early? Is it to take on more staff this year? So we'll have a look at that and go through any questions you have. And ultimately, the goal is with financial planning that you have the financial freedom to make the choices that allow you enjoy your life, that there is a work-life balance, that both from a business and personal point of view, you are able to achieve all of these and have that nice balance in terms of where you are. And a lot of this will come up today, but this here is the financial wheel of life. And what we're looking at is, when I meet people, it's looking at on a scale of 0 to 10, where are you? So really, really important in terms of the financial well-being, the control of the day-to-day and month-to-month expenses. Do you have a budget? And have you got an emergency fund in place? Are you living within your means every month? And if not, what steps can we take to get you to a better financial position? What is an average emergency fund? What should you have in place? Debt can be both good and bad. We have debt over here and we have mortgages over here. So again, if you have no personal loans or no business loans, you're at a 0. If you're up at a 10, well, is it that you know how much you have, what interest rates you're paying, and how can we reduce or how can we get the best rates in terms of that? And this is really important today in terms of mortgages, both from a commercial and a personal point of view. The ECB has had 5 rate increases since last July, and there's a lot of people concerned about your mortgage. So again, it's being aware what, number 1, how much you have left on your mortgage, number 2, what your interest rate is, and what are the options out there. The next bit would be looking at protection. So again, really, really important in terms of the capacity to absorb that financial shock can be made an awful lot easier with the correct protection policies in place. So I'm happy to go through what those are. Simple one being mortgage protection, family life cover, key man cover for that key employee, even directors, business partners. What happens? Have you got a plan in place? God forbid one of you was to pass away. What's the share buyback options? Savings and investments, again, both from a personal and commercial purpose. And again, then wealth extraction. So very important in terms of knowing where your taxes are, what we can do in terms of extracting wealth from your business. One of the easiest ways to do that is through a pension. And when's the right time to start looking at retirement? And because at different stages of your life, you will be at different times. So again, if we look that you're only starting out in your career, maybe you finish college, you're in your 20s, you're early on, you mightn't have a mortgage yet, you might have personal loans. Can we bring them down? Have you got your savings? And ideally what we want to do is by the time you get to retirement, don't have any debt, but actually have these pockets in terms of the retirement, you're understanding your tax relief and available, and in terms of investments. So that's just a very quick kind of whistle-stop tour of what financial planning, both from a business and commercial point of view, would look like if you book in with ourselves for a full financial planning review. We use cash models. So again, every person is individual, but what we can do is look at your current situation and really see where are you in terms of, are you on track to meet your financial goals, and what do we need to do in order to achieve those goals and get you out at a time with a lifestyle that you want to have.
Great, thank you, Anya. That's a great introduction. Okay, so we'll move to some questions that we have. Now, first of all, Accountant Online, we have about 2,000 or 2,500 small business clients. And over the last 20 years or so, I've had many, many conversations with business owners in terms of how they, I suppose the reasons for setting up a business. I mean, we all set up businesses to make profit and to make money, but especially in the early years and sometimes long past the early years, some directors and business owners sacrifice their personal wealth for the business. So they would extract small salaries, and they do that for various reasons. It could be tax, for example, because you pay less tax on company profits if they stay in the company rather than taking them out at high personal rates. Now, so I suppose my question to you is, how do you marry the two? How do you balance the need to build personal wealth with the need to build and maintain wealth within the business?
Yeah, I think that's brilliant. And I think with anything, good planning, having worked with you both and your company, a good accountant is key, and the financial planning side, because anything is achievable with the correct amount of time. The earlier you book in, the earlier you start a plan, the better it is, because we would come across that a lot in terms of people just not understanding that if they pay themselves a little bit more, yes, you will take yourself up into a higher tax bracket, but in terms of extracting that wealth, whether it's through, as I mentioned, a pension whereby an employer can put a contribution into a pension, so you're taking that money out of the company, putting it in a personal asset that is invested and over time should grow depending on where it is invested. You also have the opportunity to be able to put maybe smaller personal contributions in, but we would see, depending on the structure that you have, so whether you are a limited company or you're a sole trader, there's various different options based on the level of income and the where you're at on your business development model.
I was actually asked this question yesterday. I presented at a session yesterday, and the question I was asked was, how do I know as a business owner what's the right amount of money to take out for me?
Okay, so how long is a piece of string? Again, it depends on how much money you have in your business. It depends on what age you are, because I would work with a lot of people that like if you're in your 50s, from age 55, there's various different ways that we can get money out of the company that is not then exposed to capital gains tax. It's whether we can use the reliefs that are available out there. And really the other side is, it's not always about taking it out personally. It could be, well, is the money all sitting on deposit, but in 3 years' time, there's a large capital expenditure. Are there better ways than just leaving your money sitting on deposit? And we can go through all of that. So it's not always going to be retirement planning, but retirement planning and an exit strategy work very well together. And the earlier you become aware of the reliefs, because some of them are incredible in terms of how we can minimize or completely take capital gains tax out of it on the sale or disposal of a business. It's having the right advice at the right time.
Yes, and I think it depends on the stage of the business that you're at, isn't that right? Certainly in the early years, you may feel it may not be possible to take even a market salary from the business, and that's fine. A lot of directors sacrifice and business owners sacrifice personal wealth in the early years, but you're doing that because you hope it'll pay off later. And I think that what we need to do is we need to understand that you can only sacrifice personal wealth for so long, that at some stage, the business has to be able to afford to pay you. Otherwise, what are you doing? You know, you're running a business to make money. So if you're not extracting sufficient wealth throughout the lifetime of the business, then that's going to leave you in a very difficult position once you come to the stage where you have to retire or dispose or sell your business.
Correct.
Anya, thank you for that. Just talking about extraction of wealth and saving money on tax in particular. So what I always say to my clients is, don't be afraid of tax. Tax is good because tax means you're making money. So that's great. So the key is to understand, to minimize your tax liability and not to pay too much tax. But you don't want to sacrifice your personal income for the sake of tax. You know, that you can't do that. So you're in a great position if you have the ability to plan and to minimize your tax liability over the longer term. So maybe talk to me a little bit about pensions, because we hear about that all the time in terms of, and you mentioned it already in your introduction, that it is the easiest way to extract wealth tax-free and to save money on tax.
Yeah, so let me start with a sole trader, first of all, because I'm sure we've many sole traders. So there's two different entities generally when you are working for your own. You'll either be a sole trader where all of your income is taxable, or you will have got to a point where maybe the best advice was that you have set yourself up as a limited company structure. So in terms of regulations and stuff, the sole trader has less kind of auditing and requirements. So they would take out what's called a personal pension or a PRSA. So on earnings up to €115,000 per annum, the government gives you really generous tax reliefs based on your age. So if you're in your 20s, you are allowed 15% of everything you earn, and you get tax relief at the rate you pay. So currently, if you're earning up to €40,000, you will pay tax at 20%. The government will give you tax relief at 20%. So let's assume you're putting €100 a week into your pension. The government will put €20 of that in, and it's only costing you 80. That gets invested in a retirement fund. We have a number of different options, whether you are low, medium, or somebody who's more adventurous and wants to take high risk. We will match the pension to your attitude to investment. And then as you go through and you get older throughout your career, you get more and more tax relief. So somebody in their 50s can put up to 35% of their total earnings into a pension and get tax relief. Hopefully at that stage you'll be get on 40%. And if you think about this, if you're putting €100 a week in, but the government is giving you 40% back, you're only putting in €60, they're putting in 40. That is a 66% return every single week or every single month on what you're putting into your pension. There is nothing that can compete with that. And it's completely legal in terms of taking your money out. If you're then in a company and you have employees, or as a director, you can set up a company pension plan, and then the scope is huge. So exactly what Larissa was saying, maybe the first 5-10 years you're building your company up, you don't actually have the capacity to fund a pension. This is where directors are allowed, from an employer point of view, they have much more scope in terms of what they can put in. So what we say is there's the balance. Get your business, build it up. But at some point, then let's start look at, okay, now's the time we really need to start looking at how can we extract the wealth, and the government allow you backdate for all those years where you didn't have a pension. So you can build up a really good pot very quickly, even if you are in your 40s or 50s when you start pension funding.
As a director of a limited company?
As a director of a limited company.
Yeah. Okay, super. Okay, thank you, Anya. So definitely limitations as a sole trader and much more freedom if you're a director of a limited company. And really, if you're in a position to put large amount of money into a pension at that stage of the business cycle, then you probably are a limited company for other reasons anyway. Yeah. Okay, thank you.
Larissa,
Yes.
we've lots of questions, Larissa, for
Okay.
Anya, if I can put them to
great.
you on the pension. Yeah. So there's appreciation for the information so far. Since going limited, I'm paying into an executive pension and have stopped all personal pension contributions. Are there any downsides to this approach, or is it all benefits?
No, not at all, because number one, from an employer contribution going into a pension, you're reducing your capital gain, or sorry, your corporation tax liability, and you're not reducing your own take-home pay at all. So with an exec pension plan, there is no, you don't have to be putting in a personal contribution yourself. Again, that's more if you are drawing a large salary and you want to reduce the amount of tax you're paying, that's where a personal contribution would make sense.
Okay, and there's a number of questions like that. So Lindsay asks, I have a PRSA pension, but recently changed over to a limited company structure, and I've been told my pension type must change. What will the changes look like? So it's just all benefits then?
It's all benefits, okay. And the big thing now is that she's not capped at €115,000 and the age-related benefits. Yeah.
Okay, very good. And then there's some other questions I think Larissa, you may be able to answer this more easily, perhaps, is in terms of entrepreneurial relief. It's not on the subject of pensions, but certainly in terms of wealth extraction. Who is entitled to entrepreneurial relief? Is it as easy as taking out 750k when you shut your business or sell it? Is it as easy?
No, nothing's easy. Nothing's easy.
But I like the straightforward question.
Yeah, okay. Now, I mean, entrepreneurial relief is a great relief. It basically gives you 10% capital gains as opposed to 33%. So it's a big saving, but it's only on the first million, and there is terms and conditions apply, of course. There's rules over how often you work in the company, for example, and if you're full-time or part-time, and there's rules over some types of companies as well. I don't have the terms and conditions up, but essentially, yes, it's a great relief, but it's only up to $1 million. And look, we would love as advisors and business owners to see this relief extended like it is in the UK, see it extended beyond the $1 million, because really we're trying to encourage entrepreneurship in the country. But it does give you 10% relief as opposed to 33% on the first $1 million.
And how is it not as easy as this lady asks, as Karina asks, it isn't as easy as taking out 750k when you shut your business?
Well, it's just because of the terms that apply, because of the length of time you have to be in business, the amount of hours you have to work in the business. Those are the main terms and conditions. So it's not really onerous, Rose, but it's not really easy either. And it will be checked, by the way. Revenue will absolutely check it.
Okay, we have an article on that. I will share that with the participants also. Another question about pensions and self-employment from Moira. Starting self-employment route of 2 pensions with individuals that need to be combined. I imagine they're individual pensions. What's the best route to combine this without paying for the transfer of it?
Okay, well, transfers of pensions, there's no charge to transfer a pension. 100% of whatever the pension fund you have can be transferred. So what would have happened if these are previous employer pension schemes that this person has? You should have received what are called leaving service options forms when you left your previous job. So you have the option to leave it with your current company and it stays invested with the trustees, and you'll get it at your normal retirement date. Generally, we don't recommend that because depending on kind of what type of industry you're in, there's a lot of mergers and acquisitions. It may be difficult to follow up with that in the future. Option 2 is you can move it to your new employer pension scheme. So if you're setting up a limited company, you will have the option to set up an executive pension plan and move those pensions into it, and you can combine them all together. Or the one that we see a lot of people doing is where they like to retain control over these pensions. They do keep them separate, and we consider either a PRSA, depending on whether that's one of the available options, or a retirement bond. So these are called personal retirement bonds. you take ownership over them. You do have access to them from age 50 should you need them. And again, in terms of you then control where it's invested. So there's a couple of different options. We need to see the leaving service options that are there, but definitely there's no charge to move a pension. Now, again, in terms of the fund that's being transferred across, the broker may charge different fees or charges, and you need to be aware of annual management charges on pensions. So that's where I'd say book in with a certified financial planner. And if you need advice, I'm happy to go through those options with you.
Thank you, Anya. And this question is for Larissa with regard to wealth extraction. What are your thoughts on setting up a holding company above the limited company to set up dividends you don't take?
Yeah, so that's a very common structure for directors of limited companies to own the shares in a holding company, and for the holding company to own the shares in the trading company. It's very, very common. And the reason why it's so common is because if those shares are held for more than 12 months on disposal, their shares aren't liable to capital gain. So that's the reason why it's so popular. Now, it's a great way of ensuring that you won't pay personal capital gains tax on the disposal of the shares in your business. However, you have to be aware, you have to go into all of these things with your eyes open. You have to be aware that by doing that, you still don't have access to the money. The money is held in the holding company. If you were to eventually sell your business, you have no capital gains liability from trading company to holding company. But once the money is in the holding company, you still have to get it out. So you still have to either take salary or dispose or liquidate the holding company. So you have to be aware of that. So you have to have a plan to either not take it out or to take it out in a way that's more tax efficient, because otherwise you're putting a step in and you're not getting any benefit from it.
Okay, so this question is about having a limited company and moving, when he says dividends, that would be like cash, moving the cash into the holding company. But as you say, at some point, you have to extract it.
Because if you have, if your trading company issues a dividend to your holding company, so then there's money sitting in the holding company, and you as a director have to get that out. So you either get it out through a salary or through some form of extraction, but you're paying tax on it anyway. But to answer the question directly, there's no tax for you personally on that dividend because you don't own the dividend. But there is tax from the company, from the holding company's perspective.
And when you take it out, it's good.
There's personal tax there.
Okay, so there's no.
Sorry, Rose, can I just go back? There was one that came in earlier, and it's just I've been advised to get income protection. Can you explain a bit about it? Is it an insurance type product, and what happens if you ever use it? This is a really, really good question from a business owner perspective, because when you go out on your own, you're not automatically entitled to the state disability benefit. So if you're unable to work, there is the potential that you're only going to be able to pay yourself for as long as there's money in your company account. And then you're completely on your own. And what does that mean? So income protection, you can do a personal income protection policy, or your company can take it out on your behalf. It is an insurance, but it's an insurance against you being unable to work because of any accident, any illness, or any injury. If you're out of work for a period of time, let's say the company can pay you for 3 months or 6 months, and we would always recommend, as a self-employed individual, you should have a minimum of 3 to 6 months emergency fund. So net pay on reserves should something like this happens. Income protection will then kick in after a deferred period of time. You can choose that from 4 weeks, 6 weeks, you can do 4 weeks, 8 weeks, 13 weeks, so 3 months, 6 months, or 12 months. Okay. And what that means then is the maximum income protection you can take out is 75% of your full-time earnings. So now while you're out sick or because of an injury or an accident, you have your regular income coming in paid weekly until you get better and you return to work. Or worst case scenario, you cannot return to work and it pays you until you reach your retirement age. It is tax deductible. So now if you have had a pension contribution, you can still claim tax relief. So now your health issue does not become a personal kind of financial issue. And I would say every single self-employed person, it is the first thing you need. There is no point if the foundation isn't there and something happens and you're the key employee. Well, what can your business survive that? So income protection is tax deductible. The government also want everyone to have it. You will be able to claim tax relief on those premiums. So really, really good question there.
Thanks, Sonia. For an idea on the type of fees you'd have to pay there as a percentage of income, would you have?
Yeah, so it just depends on what age you are. The younger you get in, the cheaper it is. Okay,
of course.
Again, depending on what salary you want to protect, like you might only want to protect kind of 50,000, you might want to protect 100,000. You can protect up to 250,000 of a salary via income protection. So you can. It will also depend on what your previous health conditions are. So if you do have pre-existing medical conditions, that may affect the premiums and the acceptance rates.
Very good. Thanks, Anya. Larissa, if you're happy to keep taking questions, or would you like to?
Yeah, sure. We'll take one or two more and then we'll move on to the next section. Thanks.
Okay. So are there any good financial practices I should be doing as a sole trader to help me when applying for a mortgage in a few years? Now, this is actually a question that our client experience team has said is really common in the last 6 months. Because of course, as you mentioned, Anya, the mortgage landscape has really changed. So where we might have thought we could afford a mortgage may have changed now. So for both of you, I suppose, yes, what would be the good financial practices we should be doing as a sole trader to help us apply for a mortgage?
Okay, so maybe I'll answer it from the accounts perspective.
Yeah.
Anya, you can take over from the application process. So for an account, for a sole trader or indeed for a limited company, the best thing you can do to prepare yourself for any lending in the future is to make sure that you have all of your financial affairs in order, that your accounts reflect what's actually going on in the business, especially if you're a cash business. It can be very difficult for cash businesses through the mortgage application process or indeed through application for any business loans, for example. So the advice would be to make sure that you have at least 3 years of really good accounts, the best that your business can do, of course, but that they have to truly reflect what's going on. Okay. That's the first thing. The second thing I would say is to make sure that your business, especially for a sole trader, that your business account and personal accounts are separate. So your business bank statements reflect your business transactions only, and your personal statements reflect your personal transactions, and there's no crossover. And you get into the habit of transferring an amount of money, call it a salary for a sole trader, or drawings from your business account to your personal account on a regular basis, whether it be weekly, every 2 weeks, or monthly, and you stick to that. So there's no as little over and back as possible to demonstrate that your business is on a sound footing and your personal financial affairs are on a sound footing. And finally, from me, your tax obligations. So your income tax, your VAT, your PAYE is up to date, is filed and paid on time, and that there's no question around compliance with revenue, because that's one of the first things that we look for is compliance with revenue. And you need to have a tax clearance certificate in order to access any type of funding. So that needs to be maintained on a regular basis. So get into the habit of not falling behind with those bills, because that can be easy to do as well.
Yeah, and then on the personal side, that is, if I could get everybody like that, it would be amazing. But don't be afraid to book in with a mortgage provider even 6 months or a year ahead of when you think you are going to have your deposit saved, because we'll be able to guide you as to what is a bank going to look for. So there's a few key things. One is a bank wants to see your repayment capacity. An underwriter has never met you. So as Larissa clearly said, have your business accounts, have your personal accounts. Once there's a very clear separation between the two, and that the underwriter can see your savings every single month for 6 months before you apply for the mortgage, that you can afford the mortgage. So when they're looking at affordability, if you're paying rent at the moment and rent is €1,000, well, you have proved you can afford €1,000. And if you're saving an additional €500 per month on top of that, you have proven that you can afford a mortgage of €1,500 for the previous 6 months. But a bank will stress test your application. So rates are going up at the moment. We know probably there's going to be another rate increase highlighted for next month, about 0.5%. So a bank will stress test that application by 2%. So the mortgage might only cost you €1,500, but you need to prove you're saving €1,750. And that's why it's really important. The earlier you can book in, we can guide you as to exactly what a bank needs to see. Be very careful with missed payments. Check your central credit register to make sure there's no missed payments or loans maybe previously. Sometimes people aren't aware, maybe they went traveling, they left a credit card, it wasn't paid off, or there's a student loan. You need to be really careful about your credit history. There's no such thing as a good credit history in Ireland, but there is a bad credit history in Ireland. So just be aware of that. And then the other side is, as Larissa said, if you're saving, if you're paying rent, just make sure it's clearly labelled when your statements are being viewed.
Okay, thank you, Anya. Will I move on, Rose? Is that okay?
Sure, we do have some more questions, so we can leave a little bit of time before the end, if that's okay.
Sure, okay. I just wanted Anya actually to touch on, and then we'll move back to questions, to touch on just what you've mentioned, Anya, with the recent rate increases that we've seen, and they're forecasted to be further increases over the coming months. And for businesses that have a little bit of cash and maybe for whatever reason don't want to invest in pensions, which is absolutely a perfectly valid strategy if those funds are required within the business for future growth or for future capital spend. What are the options that are available to businesses now, especially as rates are increasing, in terms of maximizing return on deposit?
Yeah, so in terms of a business, if you have a lot of money sitting on deposit, you do have the option of corporate investment savings plan. If you want to redirect some of those cash savings, they still belong to the company, they're still a business asset, but we can invest them that if they're not needed for the next 3 to 5 years, obviously there's the potential to get a better return than just sitting on deposit. We've come from a negative interest period for the last number of years, depending on how much money you did have sitting on deposit. The outlook is more positive with the rates going up, that the interest rates should increase over the next while. But if you have large sums of money sitting on deposit, inflation is over 8% at the moment. It's not doing you any favours to leave it if there isn't a plan for it. That this is where, in terms of company investment plans, where the money remains as a company, or as we've mentioned earlier, you start looking at retirement relief, you start looking at different ways to build up the capital in your company that can be taken out at a later date with a minimal amount of tax on it.
Okay, perfect. Thank you, Anya. Rose, I'm going to move over to the questions that came in from social media.
Sure.
If that's okay, so we can spend a few minutes just answering them. Okay, so the first question is, at what point do you have to declare your side hustle and register as a business? I might answer that one, if that's okay. Yeah. Okay, so a side hustle is a second earning, a second revenue, and it has to be declared from the very beginning, unfortunately. So if you are earning a second income over and above either your business or your PAYE income, it should be declared to revenue and tax paid accordingly. And tax can be quite high on those side hustles because it's generally on top of an already full paying job, whether it be business or PAYE. So just you need to be prepared for that as well in terms of making that tax liability and being able to make that payment. Anya, is there anything you want to add to that?
No, what I would see is people maybe very early on. My advice is, if you feel that you're not sure if this is going to be long term, that give it a go for 6 or 12 months. Don't give up the main job. But if you feel after 12 months that this is very viable, my advice would always be keep records, keep all of the receipts, because realistically you do have kind of up to say 18 months before you need to do a tax return. So if you have all your receipts and you have records of the business that you've been done, we can still do a tax return retrospectively for the previous 12 to 18 months if it is a case that you're just trying to see is it a viable business where I can leave my full-time PAYE role?
Okay, so that's absolutely true to a certain extent. You can, what you're talking about is the tax liability. The payment date is October for the previous calendar year.
Yeah.
The challenge with doing that, just to mention, is that if you have made money, you will be landed with a tax liability with no time to prepare. So that's the one downside of doing it later. What you might be better doing is doing it just after the end of the tax year. So say, for example, doing it now for 2022, and at least that way you have until October to prepare in the event that there is a tax liability. Revenue are interested only where you're making money, where there is a business and you're making money. If there's losses, you still should declare, but those losses, of course, won't lead to a tax liability.
Yeah.
Okay.
Can I just put one other point in there? If you are starting off, I would also always recommend, you mentioned kind of business accounts, but if it is something where you don't yet have a business account, open up. If you have the online banks like Revolut or N26, there are vaults. I would always recommend 30% of everything that you take in, put into a vault, because you won't end up in that position where you've nothing saved for your tax liability.
Yeah, and that's a great tip actually for any sole trader, to have like a number 2 account for VAT and for income tax preparation, because sometimes you can get into a false sense of security that there's money in the bank, when in fact it has to go to the tax man at some stage in the future. So it's it's a very good idea to have that second account. Anya, one question here is, any tips on taking over a small family business?
Yes. So again, I actually kind of had a little kind of think about this beforehand. And a lot of the time it depends on what age your parents are. And if the business is being transferred from a parent to a child, and you're between the age of 55 and 65, essentially you can transfer that business tax-free if you hit the criteria that Larissa was talking about earlier. So it's not just very straightforward. There are 5 or 6 kind of key details that you need to be able to satisfy. The other side of that is, if a business is not transferred before age 66, even to a child, the tax implications can be quite significant. So again, if this is something that is going to happen in the future, good advice ahead of the business transfer is really important, particularly if it's kind of parents down to children, because you mentioned the retirement relief at 750,000. Potentially each of your parents can take that 750,000 retirement relief out of the company. But it's kind of a little bit misleading in terms of they don't have to fully have left the business to get that. So a lot of people kind of worry about the expertise, the advisory side of parents leaving a business. They don't always have to do that, but yet there's still very good tax relief available. The other thing is that you've been working there, that you have a good relationship, and that you do understand kind of the key customers, because very often it's the advisory piece, it's the brains behind the business. Do you understand that to be able to kind of carry it on and put your own stamp on the business as well? Don't be afraid to kind of take courses, learn and progress the business.
Thanks, Anya. And I often think, family businesses, they're so complex and they can be so difficult sometimes. They almost warrant a webinar in their own right, Rose, in terms of the complexities of them. My advice would be, aside from the tax, is obviously to get advice around tax, because the complexities are many. But the best transfers that I've seen from generation to a second generation is when there's very clear, open lines of communication, so that everybody knows and everybody agrees what the plan is. Because that can be sometimes very difficult in family businesses, where we don't communicate perhaps as much as we should, what we would like to happen and what we see happening in the future. And that goes from both the retiring people and the people who are coming into the business, because new generations have great ideas and bring a new lease of life to a business. But as Anya said, there is a lot of knowledge and skills and expertise in the older generation. So it's getting that right can be key. And sometimes it can go very badly wrong, which can be a shame to see. Okay, I'll take one more question then from social media. best way to extract wealth, we've kind of looked at that, haven't we? Are there many grants available for small startups? Anya, do you want to take that one?
Yeah, I think there are loads of grants available, and even if you take Ask Paul and where it's come from, my boss Paul Merriman has a number of businesses at this stage, but the local enterprise office has been monumental in terms of the scale and the building of our company. I think every county has a local enterprise office. They're a brilliant resource. There are other, there's private supports for startups that you can use. There's local government supports, especially kind of back to work with supports, short-term enterprise allowances that are available while you're building your company. So actually your website has a fantastic section on this that I would direct anybody to as well. But definitely first point to call, I would say your local enterprise office is a fantastic resource.
Yeah, definitely, it's the first place to go. And I know, Rose, you have to push the link there. We have a webinar with the Dublin Leo next week. Great. So feel free to log on to that if you have any questions on funding. And there is one other small question which I can answer very quickly, and that was, how to find out any resources for learning the basic steps required to start. And on that question, our website, Accountant Online, has a lot of resources on there, and we also have a webinar every month on starting your own business. Yeah. And those are all free webinars, and everything's available on the website.
And likewise, Ask Paul, we have a whole kind of financial literacy section that you can go in online. We leave a lot of our webinars up, questions and answers, that if you have time, please do go back in and kind of scroll down and pick out what's important to yourselves.
Right, thank you, Anya. Rose, back over to you for any further questions.
Yeah, sure. So yes, certainly this day next week, we've got a webinar with local enterprise office. The week after that, I know, Larissa, we had some questions around what is best sole trader limited company. That is also, it's covered in the startup webinar that we host monthly. But Larissa, you also host a Finance 101 webinar, the new business owner, which is very much, as we know, the majority of business owners are non-financial. So just to let everybody who's joined know that that's a really, again, interactive session with lots of questions. But it is, you do a presentation, Larissa, where you offer the most frequently asked questions and the most kind of concerns that business owners have. There's lots of support for us out there. The remaining questions that we have are to do with, again, illness cover. So Anya, my question is, does that cover maternity leave as well, or can it, or does it depend on the type of income cover that you get?
Yeah, so there's three main types of cover. One would be life cover. In the event of death, it pays a tax-free lump sum. There's specified illness cover, which on the diagnosis of a list of specified illnesses, anywhere between 45 and 49 illnesses, you'll get a paid lump sum. And then obviously income protection would be the most comprehensive, because there isn't a definition. It is any accident, any illness, any injury. And the surprising statistic is year on year mental health, it's anxiety and stress are the two biggest reasons people claim on income protection, followed by musculoskeletal issues. So it could be hips, knees, repetitive strain injuries. And then you get into the cancers, heart attack, strokes, car accidents. So again, if this is something that you want to look at, the same as I mentioned in terms of kind of proper business protection, that you have a business partner, God forbid something happens to them, could you work with their family? Or is there a policy in place that you can use a life policy to buy that person's shares, and the life policy goes to their family? So the business doesn't have someone without the knowledge coming in. And if that's something you're interested in, we'll go through all of that with you. That is covered in the full financial planning consultation with Ask Paul.
And Anya, I know pregnancy isn't an illness, but does that cover it? It doesn't cover there.
Pregnancy is a little bit different in terms of it's not covered by income protection, because you're not out because of an accident, illness, or injury. But unfortunately, some women will experience negative sides to pregnancy, maybe postnatal depression, maybe a very difficult delivery. if that causes you to be in a position where you wouldn't be able to go back to work, well, then income protection will kick in.
Thank you. Okay. And a question then about pensions. I have retirement accounts in the USA from my prior business there. I was organized as a single member LLC. That's not available to me. So here I'm organized as a sole trader. What I need to do is open a PRSA account here in Ireland and also consult a financial advisor who's familiar with USA retirement accounts. Do you have any recommendations for me?
Will you just send me an email and I'll come back on that? Absolutely.
Okay. Anya, we have a couple of people who'd like to get in touch with you, so we'll share your details at the end of the session at 11:30, and we'll follow up then with the email and the recording. A question from Maura. I had to invest or take out loans to build the business. Can lower payments be frozen until payments can be met from the business profits? I imagine it depends on the deal you have with the banks, doesn't it?
Yeah, engage the best thing to do in these situations is communication, open lines of communication with the provider of that loan.
Yeah, you've probably been given a loan on the basis of your personal circumstances as opposed to your business circumstances. From what you've said, if you're starting a business, it's very difficult for an early stage business to get a loan on its own merits. So do talk to your bank. They can freeze payments, and they probably will help you get to where you need to be. But do just communicate very clearly with them.
Engage with them, yeah. And then somebody who's currently receiving disability allowance, they can hold on to it if the business profits less than 140 per week. What business structure would work best for this?
Sole trader.
Sole trader, yeah. So it doesn't merit a limited company.
No, I would worry about a limited company in that situation just because of the costs of maintaining a limited company and then the cost of everything that goes along with it. So certainly a sole trader is the most straightforward structure anyway. But certainly for a situation like that, where you only have limitations in terms of how much you can earn, sole trader is the way to go.
Yeah, and we often have many clients who come to us as sole traders and want to convert to be limited company once they've been established for a while. Isn't right?
Yeah, and that happens a lot. If the business is growing and if it warrants the change. Now there's many reasons why a sole trader would convert over to a limited company. And certainly we can help them as long as it's the right thing for that business. But for this particular attendee, a sole trader is the right structure for them.
Thank you. And a question from Karina: do all limited companies pay a surcharge on undistributed earnings?
No, not all limited companies. Some limited companies do. There is a closed company surcharge that doesn't apply to all limited companies. It applies to certain income within limited companies, so passive income, for example. So if your company is a closed company, so that's less than 5 participants, and it has passive income, you can be liable to a surcharge if you don't distribute that income within 18 months. If you're a professional services company, so accountants, solicitors, that type of company, then yes, you're liable to a surcharge regardless of the type of income that it is. So it's not all limited companies.
Thanks, Larissa. And Cleena has asked, what type of companies don't qualify for retirement relief?
Companies who really wouldn't have the capacity to pay out on retirement relief. One, like as I said, that there's kind of 6 different criteria that you have to hit. So you have to own the company for 10 years. You have to be having been working in it. So there's a few different kind of just tick boxes, as Larissa mentioned earlier. But if that is something that you want to kind of go down the route, a good accountant and a good financial planner will help you make sure you hit all those criteria.
Yeah, like the main criteria is that it has to be a trading company. So, and to all of us, that's a normal company that trades. But I mean, there are companies out there that, let's say, for example, they're not trading companies. They might have a rental portfolio, for example, and that's passive income. That's not trading income. So retirement relief wouldn't apply to those type of companies. Okay. And remember, retirement relief and entrepreneurial relief are different. So entrepreneurial relief, you're getting 10% of the gain up to 1 million. Retirement relief, you're getting a max of 750,000, depending on who you're disposing it to, but it's a max of 750.
Okay. We have a couple of other questions that are related to allowances and reliefs that I think are more associated with, I think perhaps social welfare might be the best place to go, or even revenue directly. But in the last few minutes that we have remaining from both of you, that we have the good fortune of having both of you in the room, Anya, I'll ask you, are there any tips from you as a final to business owner for us to find balance between our personal and business finances?
Yeah, I think my big one would be have a budget, know kind of what's coming in, know your cash flow, what's going out every month, and try and live within your means. The other big one would be the emergency fund is there should you need it. And then you pay yourself first. So what does that mean? If you pay yourself weekly, 2-weekly, or monthly, the very first deduction that should come out when your money hits your account is into savings. If you don't have a good savings habit, start small and increase it over time.
Thanks, Anya. And Larissa, what would you say?
Okay, so I would say know what stage your business is at. So at the very beginning, when you start a business, if you're early stage startup or a small sole trader that you're only starting, you may have to be happy with not taking a proper salary or allowing or sacrificing your personal income for that of the business. And that's fine to a certain point. So it's to be aware of what stage your business is at, because once you get perhaps 5 or 10 years into the business really needs to be paying you, at more than the market rate, really, and it needs to be generating profits over and above what it pays you. And if you're not at that stage, then you have to ask questions on the viability of the business. So it's okay to sacrifice personal wealth to a certain point, but then the years go by very fast, of course. So you always have to be aware of how long you have left for retirement and to be preparing for retirement. So the business has to be generating wealth for you and for itself and building value in itself. And always build a business up to sale or to sell, even if you never intend to sell it, because what's valuable to somebody else will be valuable to you in the longer term.
Sure, very good. Look, thank you both of you. And thank you very much for the participants today who asked those great questions, because they're always of benefit to other people on the call and to people who will receive the recording later. Anya, I'm sure we'll have you back. Larissa, of course, you're back very regularly. And I'd invite everybody who participated today to check out our resources on our website, accountantonline.ie. We've got lots of great webinars, and we really are here to support you along the way for the success of your business. Anya, for people to try and contact you, what's the best way of getting in touch with you?
Yeah, so it's my name. It's anya.cullen@fairstone.ie. Or you can go to the Ask Paul _now on Instagram, and you can book in through our link tree, you can book in through our website, and you can just request me. There isn't an actual portal where you kind of go, I can book into Anya's diary. You just in the free text say, I wish to book in with Anya Cullen, but anya.cullen@fairstone.ie for any queries you have today.
Fantastic, thanks Anya. And for Accountant Online, email us at hello@accountantonline.ie. Thank you, everybody.
Thank you all very much.
To see you back here soon.
Thank you. Bye-bye.
Bye. Bye-bye.